Hi, it's Nero here from Investment Rise, and I've got a question for you. Is the RBA planning on extending this current property boom? Well, I'm not sure they actually have a choice. Let me explain, and let's begin by first looking at what the RBA had to say in their August meeting. Reserve Bank keeps Australia's official cash rate at historic low. Australia's historic low official cash rate has been kept on hold, with the RBA maintaining the conditions for lifting it won't be met for a while. The Reserve Bank of Australia has maintained the official cash rate at a historic low of 0.1% despite the nation's economic recovery turning out stronger than earlier expected. The central bank reiterated it would not increase the cash rate, the interest rate on unsecured overnight loans between banks, until actual inflation was sustainably within the 2 to 3% target range, which it does not expect to happen before 2024. Yep, that's 2024, so that's 3 years away from now that the Reserve Bank is saying that interest rates will remain that low for. Okay, so if they themselves are saying it's going to take 3 years before interest rates will rise, why are we seeing some reports out there that interest rates may rise sooner than that? Okay, and again, when you look at some of these reports out there, a lot of them are based on incomplete information. All right, and so if you stay with me until the end, my aim is to really kind of fill in the blanks, give you the complete picture, and then show you why, as a result of everything I'm about to say, why I expect the RBA will have no choice but to extend this next property boom and what it means for you as an investor. All right, so now why are people saying interest rates must rise? Well, they're jumping onto the inflation bandwagon. They're saying, look, the RBA has a target of inflation being between 2 to 3%, which is true. And then they're saying, look, inflation is higher than that. So what is inflation at the moment? Well, according to the data from the Australian Bureau of Statistics at the end of June, for the June quarter rather, inflation was 3.8%. 3.8%. Surely then the Reserve Bank is going to act swiftly and they're going to bring down inflation by increasing interest rates. Nope. Not at all, and here's why. First of all, let's look at what does inflation actually measure? Well, inflation measures the change in price levels between now and a year ago. And what happened a year ago? Well, the government put in a lot of measures to try and minimize the economic impact of the coronavirus. And so they did things like make childcare free for a short amount of time. They introduced a home builder grant, which reduced construction costs for new purchases. Then on a global scale, we had petrol prices drop because almost nobody was driving, or certainly far fewer people were driving. In fact, the reduced demand caused oil prices to go negative. But now that things have gone back to normal, of course, it looks like, relatively speaking, prices have spiked. But the RBA won't consider any of these one-off factors, okay? So rather, they consider something called the trimmed mean. So when we look at the following chart here from the Australian Bureau of Statistics measuring the Consumer Price Index, you can see this blue line, which is measuring the actual CPI, sitting at 3.8% for the June quarter. However, the trimmed mean, which takes away all these one-off factors that I mentioned earlier on, it's only sitting at around about 1.6%. So that means in real numbers, real inflation is sitting at only 1.6%, which is obviously below 2%, which is below the minimum target that the RBA has for inflation. So then it's no wonder they're not planning on increasing interest rates, right? If anything, and I'll talk about that in a moment, they may even reduce rates. And the other thing to consider is it's because real inflation is so low at 1.6%, it's no wonder the RBA is happy to keep printing $4 billion a week until November. Now, that's down from $5 billion a week. I get it. And again, some people are saying, oh, that shows that inflation is increasing. No. I mean, how on earth would any of us even notice a difference between $5 billion a week and $4 billion a week, right? We wouldn't even notice. Okay, so again, when you look at the actual data and look at the complete picture, it shows you that interest rates are almost certainly here to stay low for quite some time yet. And that's why in the article I referenced a bit earlier on, we see the following comments from the Reserve Bank Governor. A pickup in both wages growth and underlying inflation is expected, but this pickup is likely to only be gradual, Governor Philip Lowe said after the RBA's monthly board meeting on Tuesday. In the bank's central scenario, it takes some years for the stronger economy to feed through into wage and price increases that are consistent with the inflation target. So the fact is, low interest rates are here to stay until 2024 at least. And there's still billions of dollars floating around the economy. So from my perspective, in my opinion, as long as rates continue to stay low, as long as there's all this extra money floating around in the economy that banks want to lend out, and when you look at the fact that we have significant supply shortages, I believe property price rises are here to stay in many areas. But I think the RBA is going to have no choice but to extend this property boom. Okay? And why? Well, bizarrely enough, it's as a result of the lockdowns. Now, there is no doubt the lockdowns have adversely impacted on our economy. Certain jobs have been lost, especially in, I guess, hospitality and tourism in industries. There's no doubt about that, okay? And so many economic analysts are expecting the economy to contract or, I guess, reduce in size over when the results come out for the September quarter, right? But if we have a contracting economy, that means then that inflation is decreasing, not increasing. The government, or rather the RBA, needs the economy to expand for inflation to increase. So if it's faced with a contracting economy, which is bringing inflation down, which is against its goals, what can the RBA do to counteract this? Well, they can do any of the following three things. Number one, they can reduce interest rates to potentially zero from their current 0.1 levels, or even go negative for the first time in Australia's history. That's one option. Secondly, they could increase the amount of money they're printing from $4 billion, maybe take it back up to $5 billion, or even say they'll print money for longer than the current deadline of November, either way putting more money into the economy. Or number three, they could choose to do nothing, but then just decide to keep interest rates low for longer. Now, whichever of these three options they choose, here's one thing that I can tell you. The reason for them taking one of these three options is because they want to obviously expand the economy, improve jobs growth, improve wages growth. All of that is very important and needs to be done. But as a result of that, what I think you'll see is that property prices will keep rising for longer. Why? Because when there's all this extra money floating around in the economy, and we've seen it right now, we're not seeing inflation in terms of consumer goods and services, right? So where's all that extra money ending up? It's ending up in real estate. It's ending up in assets, and primarily real estate. And that's why we're seeing prices rising so much, okay? So therefore, what do I think is going to happen as a result of these lockdowns? I think the RBA will put in policies to invigorate the economy, which again is going to result in prices rising sometimes even faster than they already have been in some areas. But I think overall in the good areas where supply is less than demand, where there are supply shortages, you're going to see price growth significantly in those areas. So as an investor though, what does it mean for you? It means that if you haven't jumped in yet, right? If you haven't taken advantage of the current property boom, consider this your second chance. Right? Consider this your second chance to jump in and take a huge chunk of capital growth in the right areas. Please do your due diligence. Don't just buy randomly. Yes, make sure you're buying in areas where demand is greater than supply and there's good infrastructure growth and all those other key capital growth factors. Yes, but if you do your due diligence and you buy in the right areas, I think as a result of these lockdowns, you have a second chance to grab a good chunk of capital growth, and I really hope you'll go out there and take it. Hey, thanks so much for watching. If you found this video valuable and you're thinking you might like my help to help you find an investment property, then head on over to nerocall.com to discover our unique 5-step process that's helped my private client group purchase now well over $66.2 million worth of property. And then, if you like what you see, you can book in for a half-hour phone consult with me personally. Either way, thanks again for watching.